Well, I'd probably start by telling the board to forget almost everything they know about direct listings because there's so much misinformation out there. And if you're picturing right now in your head Spotify or maybe Palantir, you're really picturing a very different transaction. Have you ever wondered what's really happening inside the emerging growth markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
My name is Caroline, and welcome to Inside the Emerging Growth Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the emerging growth and microcap ecosystems and break them down in a live question and answer format for Joe to give you his take from the trenches. So before we get into today's topic, Joe, can you just give us an update on what you're seeing from the front lines of the emerging growth world?
Yes, thank you, Caroline. And what a 2 weeks it's been in the emerging growth markets. I'm pretty sure that everyone likely knows by now that the Securities and Exchange Commission passed the new $5 million market cap rule that was proposed by NASDAQ back a few months ago. And then 7 days later, there was a objection filed by the Small Public Company Coalition, basically putting the commission on notice that they were going to make a petition for review. And 7 days later, the commission put out a stay related to that request. And within 8 days, the rule went from being passed to stayed. And now this process has to play out. And I'm sure we're going to talk a lot more about that in the coming episodes, in the coming weeks. But for right now, the entire industry went from thinking 200 companies were about to get delisted on September 3rd to everyone taking a collective sigh of relief and waiting for the commission to rule on whether or not they are going to extend the comment period for this petition and actually take a look at it themselves as the commissioners.
So let's get into some of today's questions. And for those of you that are new to the show, these are real questions coming out of the market right now from companies, boards, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions@lucbro.com, and we might cover it on a future episode. Today, we're talking about direct listings, and I have to tell you, when we started preparing for this episode, I thought it was going to be pretty straightforward, but I was definitely wrong. The more we talked about it, the more we realized today's direct listings look very different than they did just a few years ago. In fact, there's actually so much to unpack that we decided to devote 2 episodes to this topic. Today, we're going to focus on why direct listings are making such a comeback, who's using them, and why boards are looking at them differently. Then chapter 2, we'll get into how these transactions are actually being structured. So, Joe, let's start with the big picture. Why are direct listings suddenly one of the hottest topics in the emerging growth markets?
You know, Caroline, I think that's the right place to start because I don't think this is a conversation just about direct listings. The way I think about it is this is really a conversation about how companies are starting to think differently about going public. You see, for a long time, there was really only one path that everybody focused on. If you wanted to become a public company, you generally hired an investment bank and went down this traditional IPO path, and hopefully the deal got done. But today, I'm hearing a very, very different conversation coming out of boardrooms and from issuers and founders. instead of asking, how do we do an IPO? I am starting to hear more and more, what's the right way for us to become a public company? And once you start asking that question, direct listings naturally become part of that conversation.
So why now? I mean, what's changed over the last few years that's causing boards to look at them differently?
Well, I think a couple things are happening at the same time. We've spent a lot of time on this podcast talking about how much more selective the traditional IPO market has become, especially after the new discretionary listing rules that went into effect at the end of December in 2025. So that's certainly part of it, but that's really only half the story in my mind because the direct listing concept has also evolved. In fact, one of the biggest mistakes I still see people make in the market is really trying to analyze today's direct listings using a playbook that probably has been outdated for a few years. That really doesn't work anymore. And the rules have evolved and the structures for financing around the direct listings have also evolved. Even more importantly, I think boards have gotten more sophisticated on this topic. So they're looking at the public markets through a very different lens than they were just a few years ago.
All right, Joe, now you've got me really curious because when I hear direct listing, I still picture Spotify. I picture a big company that already has plenty of money and just wants its existing shares to start trading. That's not really what we're talking about today, though, is it?
No, not really. Although that type of direct listing certainly still exists. And honestly, I don't blame you because for a long time, that's what people associated with direct listings. If we recorded this episode 5 years ago, I probably would have answered the question the same way. See, because back then, most of the attention was on larger companies that really weren't looking to raise capital. They were just registering existing shares and creating a public market for their shareholders. Today, the emerging growth version we're seeing looks very different.
So, what do you think changed?
Well, first, the rules changed and the financing structures around them changed. But I think more importantly, the industry just got a lot more creative on these topics. So when you combine all of that with how the traditional IPO has just become a lot harder of a transaction, boards and their advisors really start looking at these alternative pathways, including direct listings, and going down that path. And that's really what we're seeing now.
Okay, so let's pretend I'm sitting in that board meeting. What's the first conversation? And are we deciding we want to do a direct listing or are we deciding where we want to list?
Honestly, Caroline, those conversations usually happen together. One of the first things we evaluate when we're looking at a direct listing is whether or not that is even a realistic option for that company. You see, direct listings aren't right for everybody. So you really have to do a careful analysis, but that's really where the exchange decision becomes a very important part of the initial discussion.
Really? Why is that?
Well, because the exchanges don't approach direct listings the same way. And this surprises a lot of people. If you're an emerging growth company and you're seriously considering a direct listing, you are almost always talking about NASDAQ. The New York Stock Exchange generally is not a path for an emerging growth direct listing. In most cases, the staff at the New York Stock Exchange, they're going to steer that company towards a traditional IPO instead. Now, again, if you're talking about a much larger company or a much more established company, well, that's a different conversation that you'll have with NYSE. But for companies that we represent and the companies that are in the emerging growth, this usually isn't an exchange conversation or a choice between two exchanges. Historically, NASDAQ has been receptive to the emerging growth world for direct listings, and NYSE has generally expected those same companies to pursue a traditional IPO.
Wow, I honestly didn't know that. So, if I'm a founder or a board member thinking about a direct listing, I may not really have two practical exchange choices.
That's right. You have one practical exchange choice. And a lot of people assume that when you decide on the transaction, you first have to pick the exchange. But in our experience, those decisions happen together. And when you're an emerging growth company, it is always NASDAQ for the exchange. So we're looking at a company, how much capital it needs, maybe looking at its shareholder base, where it is in its life cycle. things like that. But we're really not thinking about the exchange when it comes to direct listing, unlike other pathways. We really tried to build a strategy around other factors going on at the company, and the exchange in this instance really becomes an afterthought.
All right, so let's stay in that boardroom. I mean, we've decided a direct listing deserves serious consideration. What does a modern emerging growth direct listing actually look like?
Well, I'd probably start by telling the board to forget almost everything they know about direct listings because there's so much misinformation out there. And if you're picturing right now in your head, like you said, Spotify or maybe Palantir, you're really picturing a very different transaction. Let's take a typical emerging growth company. I mean, it could be anything, biotech, AI, advanced manufacturing. I mean, you name it. The industry really isn't important. If it has a good management team, if it's raised money privately, if it has a good shareholder base and the business is progressing and growing, then those are the factors that we really look at that can make the architecture of a direct listing.
So, wait a minute. You just said that the company still needs capital. I thought direct listings were for companies that didn't need to raise money.
Well, you're not alone. That's probably one of the biggest misconceptions I hear in the marketplace. You see, 5 years ago, I probably would have answered that question the same way. But today, it's not unusual to see a company raise money around the direct listing process. Sometimes it's private capital that's really raised before the listing. And sometimes there are maybe structures that will allow capital to be committed and held in escrow until the listing occurs. So it isn't necessarily raise money or do a direct listing. Those two pieces can really work together as part of a larger capital markets strategy.
So, before we get into all of those mechanics next time, what happens when the company actually lists?
Well, at a high level, the company, remember, is registering its existing shares for trading. So NASDAQ establishes, along with the company, a reference price, which basically gives the market a starting point. And then buyers and sellers will determine where that stock actually trades. But again, there has to be an opening reference price based on some type of valuation submitted to NASDAQ during the process. So you don't have the same traditional dynamics as you would in an IPO process where the bank goes out and builds an order book. They may allocate shares to certain investors, and then you do a underwritten offering when you list. That's really the major difference here.
So, Joe, who do you actually think is a good candidate for this? Because I'm assuming the answer isn't just every company that can't get an IPO done.
No, certainly not. Every company that cannot get an IPO done would not qualify or would not necessarily qualify for a direct listing. I think a good candidate for a direct listing is one that likely has been around for a good amount of time. They've raised private capital. They have a meaningful shareholder base. And of course, they have to have a growing business that has the ability to get a significant valuation on day one in order to list. And that's a little bit different than some of the criteria that we traditionally look at for the IPO process. So sometimes the market will dictate maybe what is eligible for. And other times, I think the boards and advisors will dictate, the right transaction structure for that company. But every company should not, and would not, and I would not recommend simply go down the path of a direct listing, even if an IPO is not available.
So, this seems like it's not really about finding the easiest path, it's actually about finding the right path.
I think that's the right way to think about it. And like I said, I think this is where the market has been moving. People are getting away from defaulting to the traditional IPO and really thinking about this topic because some of the biggest mistakes I see happen when companies start with the transaction that they want instead of the transaction that actually they may have the ability to execute and get listed. And that's really where judgment in the marketplace matters.
You said something that caught my attention. You said some of the biggest mistakes happen before the transaction even starts. Could you give us an example of that?
Sure. And honestly, I don't think one of the biggest mistakes happens 6 months before a company goes public. Sometimes it happens much earlier than that, maybe even 1 or 2 years.
How does that happen?
Well, remember, every time a private company raises money, it creates another benchmark. It creates another valuation. It gives another group of investors a spot on their cap table. And eventually, those benchmarks have to make sense together when being evaluated for a listing. I mean, let me put it this way. Let's take a simple example. If a company raises money, say today at a $20 million valuation, and maybe a year later it becomes a $40 million valuation, and another year goes by and perhaps it's a $75 or $100 million valuation, that is a growing business that's hitting milestones, creating value, and that progression makes perfect sense. Now, let's change one fact in that story. Let's say the company raises private money at a $20 million valuation, and then only a few months later, it walks into NASDAQ with a valuation saying it supports $200 million direct listing. I can almost tell you the first question that is going to come out of the staff's mouth at NASDAQ, and it isn't, hey, congratulations on a great valuation. It's going to be, wait a second, I don't understand. Walk me through how you got to that valuation in such a short period of time.
Well, why don't you walk us through what that means?
Well, NASDAQ is certainly going to want you to explain that valuation of progression, and they're going to look at that transaction absolutely with a skeptical eye unless the company has a very good narrative. So the first thing you're going to want to know is what happened between the $20 million and $200 million progression in the valuation. Was there a major acquisition, or did the company secure a major contract? Something that makes this transformational valuation go up by 90%. You really have to have a catalyst that fundamentally changes the business. The answer simply can't be, well, we're going public now and that's how we got to our valuation. There really has to be a compelling explanation and narrative. So NASDAQ is going to naturally spend a lot more time understanding how you got from one valuation to another.
So let me ask you something else. Does it matter who prepares that valuation, or is a valuation report basically just a valuation report?
No, it definitely matters. Now, is it the most important criteria in the listing process? No. But I think sometimes companies really underestimate this part. And people sometimes think the goal is finding someone who will give them the highest valuation or give it to them for the cheapest price, because I recognize money is tight when you're talking about private companies. But the way NASDAQ looks at it is it's the exact opposite. The goal is to really find someone whose work will stand up to scrutiny and be able to be explained. So credibility really matters, but more importantly, the methodology that the valuation expert uses and their experience really matters more. So when it comes time for NASDAQ to inquire, the methodology and how they got to that valuation can be defended.
So it seems like it's really about whether the valuation can stand up to scrutiny.
Yes, that is definitely true. NASDAQ isn't going to look at this report, remember, in isolation. They're going to look at your prior financings. They're going to look at, your milestones, maybe your growth, and whether that progression and where you raised capital over time, whether that makes sense. And that's why I tell founders not to think only about their capital raising today, but really think about the future and what that may look like 6 months from now, 9 months from now, a year from now. Because remember, you are going to have to explain that to somebody, whether that's the SEC in your disclosure filings or NASDAQ in your application.
I mean, that's probably not how most founders think when they're trying to close a private round, right? They're worried about getting money in the door.
Yes, I totally understand that. They are definitely trying to solve today's problem. I'm also not suggesting, though, that if you haven't spent the last 2 or 3 years planning a direct listing, that you've somehow missed your chance or missed your window. You haven't. But if you had the luxury of thinking ahead or planning ahead, you should use it, because experienced boards understand that today's financing decisions will definitely affect actions and decisions for tomorrow. And eventually those decisions become part of the company's permanent record and becomes part of their story. So if your valuation takes a major jump, there should be a good business reason behind it. Otherwise, you're just creating questions later on for the exchanges and perhaps the commission that you're not going to want to answer.
So, Joe, before we wrap up chapter 1, let me just take you back to where we started. Do you think that direct listings are really here to stay, or is this just a response to an unusually difficult IPO market?
Well, I don't think direct listings are going to replace the traditional IPO anytime soon. For many companies, even in this environment, I think the IPO is going to continue to be the gold standard. But let's step back and look what's happening a little bit, at least here in 2026. Remember, when we've talked about this on prior episodes, and I've spoken about this around the country, alternative pathways to getting public have outpaced the traditional IPO, at least here in 2026. And direct listings are a very important part of that conversation. So I don't think we've ever seen an emerging growth market where those alternatives have taken over the traditional IPO. And again, this all goes back to the new rules that went into effect from NASDAQ in December of 2025. And, boards aren't, again, just asking, how do we do an IPO anymore? They are definitely asking smarter questions and trying to find meaningful paths to getting public. And the alternative pathways, including the direct listing, are certainly a large part of that conversation. And I don't see that changing anytime soon.
Well, Joe, I have to tell you, when we started planning this episode, I wasn't exactly sure that we needed 2 chapters, but now I get it. Today, we really focused on why direct listings are making a comeback and how boards should be thinking about them, but we barely scratched the surface on how these transactions actually get done.
Yeah, I think that's right. And there's a whole other discussion that I think we need to have around how these deals are structured and how companies raise capital around the direct listing and some of the more creative approaches that we've been seeing in the marketplace.
Then that's exactly what we're going to do next time, because I think once people understand why direct listings are back, the next logical question is, all right, well, how do these deals actually work?
I totally agree, Caroline. But before we leave today's discussion, I just want to make one other point. I think that it's really important that you don't start with the transaction itself in mind. So if you're a founder or a board, I really want you to start thinking about whether going public is the right approach. And if that is, then start with understanding where the company is, where the business is going, what the capital needs are, how many shareholders you have. And if you look at it from that perspective, you will then be able to decide whether a direct listing is a good strategy or maybe the IPO or some other structure could work well. But again, don't let the tail wag the dog. Do the homework up front to decide what structure makes the most sense.
You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.